Good afternoon, everyone. Welcome to a webinar with Dr. Carmen Reinhart on the economic impact of COVID-19 in Latin America and US relations with the region. For those of you who don't know me, I am the Executive Director of CasaCuba. My name is Maria Carla Chicuen, and I am delighted to join Carmen, distinguished Cuban economist and FIU alumna. Briefly, for those of you who are having your first meeting with CasaCuba, CasaCuba is a new initiative of FIU, Florida International University in Miami, to build a leading cultural and intellectual center for the preservation of the Cuban heritage and the discussion and study of Cuban affairs. CasaCuba has launched a virtual ventanita in response to the crisis to continue our engagement with our community in Miami and beyond. And you are welcome to participate in CasaCuba's virtual ventanita through our website, casacuba.fiu.edu, and throughout our social media platforms and newsletter. We will be featuring cultural content. We'll be featuring expertise and notes on the impact of the crisis in Cuba and the region at large. And we are very proud to start a series of webinars with renowned experts in Cuban economy, politics, society, and culture that we've titled Briefings on Cuba. Just very quickly on the flow of today's presentation, we will be hearing from Carmen Reinhart and questions from the audience will be welcome. We will be taking them throughout the conversation after our initial presentation, but you are welcome to send your questions through the Q&A chat feature of the Zoom platform, and we will be taking them after Carmen's presentation. And this webinar will also be recorded, and you will be able to access it and share it afterwards. Without further ado, I would like to officially introduce Carmen Reinhart, the Minos Zombanakis Professor of the International Financial System at Harvard Kennedy School. She was Senior Policy Advisor and Deputy Director at the International Monetary Fund and held positions as Chief Economist and Vice President at the investment bank Bear Stearns in the 1980s. She serves in the advisory panel of the Federal Reserve Bank of New York and was a member of the Congressional Budget Office panel of economic advisors. She has written on a variety of topics in macroeconomics and international finance, and her work has helped to inform the understanding of financial crisis in both advanced economies and emerging markets. Her best-selling book, entitled This Time is Different, 8 Centuries of Financial Folly, documents the striking similarities of the recurring booms and busts that have characterized financial history. Based on publications and scholarly citations, Dr. Reinhart is ranked among the top economists worldwide, according to research papers in economics. She has testified before Congress and has been listed among Bloomberg Market's most influential 50 in finance, Foreign Policy's top 100 global thinkers, and Thomson Reuters, the world's most influential scientific minds. In 2018, she was awarded the King Juan Carlos Prize in Economics. Thank you, Carmen, for joining us today, and thank you all for joining us as well.
Thank you. Thank you, Maria Carla. And well, what I'd like to do is, first of all, give some context, historical context and geographical context to the COVID-19 crisis. I'm going to talk also very much in terms of the US economy, the global economy, Latin America, how it compares to earlier Latin American crisis, how LATAM is going to fare, is expected to fare vis-a-vis other regions. And what I would welcome is, for the first 15 minutes, I'm just gonna lay the general landscape. And then anytime after 15 minutes, please send in, any questions you have to make sure that I'm able to address them in this webinar. So let me start with my book, This Time is Different. And This Time is Different is meant to be an ironic title, meaning that, every time, whether it's individual government officials or the financial market participants, when prior to a crisis, when there's a boom, they convince themselves this time is going to last forever. We're doing that right now with the equity market, by the way, with the US equity market. This time is different. It has, so it was meant to be ironic. However, when it comes to the COVID-19 crisis, believe me, this time is different. We, the human race has had pandemics throughout history, and I'm sure all of you are hearing, as a point of comparison, tales about the Spanish influenza of 1918 to 1920, which by conservative estimates, it killed 50 million people worldwide, and by more modern, well-informed estimates that are more recent, it killed close to 100 million over the course of 1918, 1919, and 1920. The first thing I did when COVID started to emerge, not just in China, but when it emerged in Italy and shortly thereafter in Spain, was start to see what did the economy look like in 1918, 1919, 1920. That exercise was relatively useless, actually. In the United States, the deaths from the Spanish influenza peaked in 1918 at 675,000 people who died that year. You have to consider this is over 100 years ago, so it's a much smaller population. This is the deadliest pandemic in modern history. And that year, 1918, real GDP in the United States grew 9%. Business failures, which are a major concern at the moment, and I will certainly talk much more about that. Business failures actually fell. You had very low-level business failures, but a perhaps overly simplistic answer, but very important answer is the US in 1918 was also in the middle of World War I, and the whole economy was geared towards production, wartime production. And so this whole dislocation that we're seeing at the moment is truly unprecedented, not because we haven't had devastating pandemics before, but because the policy response of the massive global shutdown are new. That's the really new element in all of this. It's not the financial crisis. I am going to talk quite a bit about earlier financial crises that are very relevant to the Latin American history. But the part that's new is the policy response that says, okay, we're going to, respond to avoid the human toll, to avoid the death of an unknown fraction of the population, because remember, this is a new virus, so we really have been at sea as to what to expect. That part is new, and this is what's generated a global depression. Over a month ago, if you don't have it, I will ask Maria Carla to send it to any of you who are interested. I write regularly for Project Syndicate, which is published in many newspapers globally. And I wrote a piece about a month and a half ago that said, look, the right comparison, and this is particularly relevant for Latin America, the right comparison of the current environment is the 1930s. In the 1930s, the 1930s depression did not start because of a pandemic. This crisis did not start because of a financial crisis. And yet, why would you think I am comparing the two? Well, let me try to lay out a little bit of what my reason for comparing those two episodes are. First of all, if you know, I don't know how involved you were. I was certainly very involved during the global financial crisis of 2008, 2009. 2008, 2009 was called a global financial crisis, but in effect, it was a crisis for 11 advanced economies that had serious banking crises, including the US, because of an overheated, bubbly housing market. And the bust in the housing market created all kinds of strains and financial difficulties in the banking system and the financial sector at large. But if you look at who was really hit hard on a sustained basis, it's 11 advanced economies. This is the US and another 10 European economies. The emerging markets had a really bad time, and this was true certainly for LATAM, in late 2008, beginning of 2009, but the recovery was V-shaped, okay? It was importantly V-shaped because China, at that time, between 2003 and 2013, China was growing at an average rate of 10%, more than 10% a year. And why was China so important for LATAM? Commodity prices. Latin America is still in varying degrees and different commodities, but its economic cycle has been historically and continues to be intimately connected with global commodity prices. Commodity prices during the 2008-2009 crisis were quite elevated in effect. In my study of crises and international capital flows, one of the things obviously that I study is international commodity prices. And what I call the China boom in commodities was the longest commodity boom since 1790, when my data begins. So unlike the 2008-2009 crisis, emerging markets are in this big time, and the odds, in my view, of a V-shaped recovery are very small. I will talk more about that. If you go back to the 1980s, which is actually around when I started at Bear Stearns decades ago, this was the crisis that triggered the lost decade of Latin America. Began in August of 1982 with the Mexican default. That crisis, which was extremely severe in emerging markets and particularly severe in Latin America, lasted about a decade. Latin America didn't emerge until the debts were restructured under the Brady Plan in the early 1990s. But that crisis was an emerging market crisis, not an advanced economy crisis. The last time that you had both advanced economies and emerging markets in a deep crisis, deep economic and financial crisis, was the 1930s. So that's number one reason why I compare the current environment. And as I said, I'll send Maria Carla the piece so that if you're interested, you can see this write-up. So number one, it is a global crisis, truly global, like the 1930s. And it encompasses emerging markets and advanced economies, and it encompasses every region of the globe. Number two, I've already alluded to this. Another feature of the 1930s depression, and this is where we are now. We're in a depression. We're not in a recession. We're in a depression. Was the collapse in commodity prices. Now, if COVID was not enough, what we have had is also another major shock hitting the global economy, and that is the Russian and Saudi Arabian oil war. Ecuador. I was interviewed by the Ecuadorian press, and I said, look, this was almost 2 months ago, and I said, look, if you escape a debt crisis in this environment, it'll be a miracle. Oil prices having crashed the way they have has really hit hard, big Latin American institutions like Pemex, who had a lot of problems even before the Russian Saudi oil war, has hit sovereign ratings for Mexico, has hit sovereign ratings for Colombia. Ecuador is in selective default status at the moment. Venezuela is a different, separate case. They are, they were already gone. But it's hit every major oil exporter, but it doesn't end with oil prices, because oil is always, there's a lot of cross-correlation across different commodities. So other commodity prices have been depressed as well. Importantly, because unlike 2008, 2009, this time it isn't just weakness in Europe, weakness in the US, it's also been a crash in China. China's first quarter GDP registered a GDP decline of over 20%, which is the largest on record since the quarterly data on GDP are available. The unemployment rate that was released this morning for the United States is the worst on record. It is the largest hike and the highest level since the series was introduced in 1948. Of course, there is another less formal series constructed by academics that goes back to 1900. And then you start saying that the unemployment situation in the US is mirroring much more closely the 1930s than anything that had happened since World War II. So the second reason why I compare it to the 1930s is, as I said, the first one was the similarity that, in the two episodes, that it is global. The second is the very weak global commodity markets. The third reason I compare it to the 1930s is that financial market volatility has been of a different order of magnitude than even in 2008, 2009. I don't know how many of you are familiar. I mean, if you're in the financial industry, obviously you are, but this is, obvious. There are many reasons why you wouldn't be familiar with the so-called VIX, which measures the volatility it's a measure of volatility in the equity market, in the stock market. And the VIX for March and April of this year had readings that you had not seen since the 1930s. This volatility, by the way, this is not like I'm talking about something that's, nice, cute historical interest. This is huge for Latin America, because what the VIX captures is risk aversion. It's investor risk aversion. So there, in all the academic literature, there's a very strong connection between the VIX, the volatility in equities, and which is a measure of risk aversion, and capital flows to emerging markets. If you look at capital flows to Latin America and capital flows to emerging markets, the abrupt reversal that we have seen in the last 6 weeks, this is weekly data from the IIF, the Institute for International Finance, which they publish, weekly data on capital flows to emerging markets, the reversal. We went from some inflows to massive outflows. That reversal in 6 weeks has been as big as the reversal that it took a full year to materialize during the 2008-2009 crisis. This is how abrupt this crisis has been. So market volatility, rising risk aversion, which hits emerging markets particularly hard, is another common feature with the 1930s. The final and fourth feature that I'd like to highlight before I start talking about what to expect, besides uncertainty, because I'm very frank with what we know and mostly what we don't know. But the fourth feature I'd like to highlight as a parallel between the current situation and the 1930s is the collapse in global trade. The World Trade Organization put out a couple of weeks ago estimates that said, well, look, global trade could fall anywhere between 13% and 32% in 2020. That's a huge range, but if you take the midpoint of that range between -13 and -32, you would get, if you take the midpoint of that decline, you would get the worst global trade contraction since the very protectionist 1930s. So, if you were not depressed before starting this webinar, you might be at the end of it. But it really, I can't highlight how risky, how difficult the global situation is at the moment. Now, what about what's next? What is, let me start again on a more negative note. Again, recounting already what has happened, what is water under the bridge, if you will, with Latam. Latam started this crisis in varying degrees in much weaker footing than what they were in 2000 when the 2008-2009 crisis broke. In the case of Mexico, Colombia, Venezuela is a separate case, Ecuador, as I mentioned already, they're pretty hard hit by the weakness in oil prices. The oil prices needed to close the fiscal hole are much higher than the oil prices that we have in the current market. They started with levels of external debt, dollar debt, that are higher. This is a problem, okay? Because if you look, which are the currencies? I did a presentation for the New York Fed. As Maria Carla mentioned, I am in their academic advisory board. I did a presentation in which basically, be happy to send that, looked at a bar chart of the change, the percent change in the exchange rates globally of all currencies vis-a-vis the dollar, and among the hardest hit, among the biggest declines, apart from Lebanon, okay, which has that, and Russia is also up there, but Brazil, the real has taken a major hit, the peso has taken a major hit, Colombian peso, not as hard, but it's taken a major hit. A lot of the a lot of the concerns that are brought about by a weaker currency is that in varying degrees, those countries have dollar debts. Brazil the least. Brazil has most of the Brazilian debt, which is very high. As I said, it's starting from a much weaker fiscal position. In Brazil, most of its debt is domestic currency debt, domestic law. But increasingly, taking advantage of the era of low interest rates in the last decade. In 2008, everyone in Latam had much lower levels of dollar debt than they do today. And sometimes it's been the government, like in Chile, sometimes it's been the corporates, or sometimes it's been both. But one thing that hits also in this crisis, emerging markets, and especially emerging markets with dollar debts, is the fact that the dollar has strengthened so much, because your ability to service that debt, you need more pesos now to repay those dollar debts. And that, is yet another, another source of vulnerability. But getting back to the issue of finally, just so I complete the taking stock, all these things I've been discussing: the weakness in commodity prices, the weakness in currencies, the slowdown in growth, the higher levels of external debt, the higher levels of domestic debt, because domestic debt obviously also matters. It's particularly worrisome for Brazil, which is in uncharted territory at the moment. All of that, the bottom line is credit rating agencies have been exceptionally busy doing downgrades. So Mexico's been downgraded, Brazil is on negative outlook, Colombia was downgraded, Argentina and Ecuador already in selected default, so I'm not gonna. There have been, downgrades of the smaller countries in Central America as well. There have been downgrades of the small islands in the Caribbean because of their reliance on tourism, which at the moment has been non-existent. So emerging markets, it's possible today, by the way, Italy also gets downgraded. Already we've seen, from Fitch, actions in that direction. So the downgrades are not just an emerging market phenomenon, but they've been particularly hard in emerging markets, and particularly hard in Latin America as a whole. And one of the reasons that I am very concerned about the downgrades is the more, the lower the quality of the rating, the less appetite there will be for from the investors for their debt. Every notch down in a credit rating puts that country's probability closer, or reflects that country's probability of default is that much bigger. And I do think that at the household and corporate level, we're going to see large-scale bankruptcies. We're likely to see them, and we are seeing them. Not likely to, we are seeing them in the United States. We are seeing them in Latam. We are seeing them in India. In India, non-performing loans in the banking sector are expected to double, so that about a quarter, or a little over a quarter, of all loans are going to be non-performing. If you look again at what the rating agencies have been doing, they've been busy not only with the downgrades of sovereigns, but also the downgrades of financial, of the banking sector and corporates as well. What is the prognosis of this? I think the most important thing I have to do is convince you that I am completely ignorant about the medical evolution of the coronavirus. I have no idea whether A, there will be a vaccine, B, whether there will be another wave, and C, whether the second wave will look like the first wave. This is terribly important, because the influenza epidemic that I talked about at the outset of this discussion, or this conversation that we're about to have, is that pandemic came in 3 waves. The second wave was the worst by far, in terms of deaths, in terms of the severity of the disease. So the whole idea that we really don't know what the path is going to be is very difficult, makes economic forecasting, and I say this in my article that I mentioned earlier, it makes any kind of economic forecast a little better than guessing, because the second half of this year looks very different in every respect. If there's a resurgence of infections, than if they pan down. And what's also very relevant in terms of the prognosis is the economic downturn has been quite synchronous globally. You see, China went first, okay? So China's hard quarter was the first quarter. Europe and the US, it's going to be the second quarter, even though Europe was somewhat ahead. But the lockdown has in place in most of LATAM and most of the emerging markets, has also meant that the output decline has been synchronous, but this disease is not. So some of the medical prognosis, the medical expectations is that the virus, the hotbed of the virus are more likely to start emerging in South America later this year. So you really can't talk about normalization of the global economy until the coronavirus is out of the global picture. Because how can we talk about normalizing trade, normalizing tourism, normalizing activity and lockdowns and the like in full force if part of the globe is still being, newly impacted by the pandemic. And that makes the outlook very, very cloudy. But let me say that from day one, and as I said, what I'm also summarizing here is some of my thoughts, about a month and a half ago, is that this crisis, which started out as a health crisis, has become a financial crisis with associated bankruptcies, unemployment that is off the charts, a crash in global trade and global demand, And I am afraid that one of the factors that I worry about in the context of much of the globe is whether this is also followed by a food crisis. I'm not talking about the extremes that we're seeing because, sub-Saharan Africa, East Africa has been, literally coping with, a virtual famine arising out of the locust, the swarms of locusts that I'm not talking about on that scale, but I am talking about a big relative price increase, price hike for food items because international supply chains are interrupted. A lot of the migrant labor that often works in agriculture doesn't have the normal seasonal cycle because mobility is limited. And this means that the period of hardship that we're seeing, unless, and again, I am by no means a medical expert, so for all we know, we may be this close to a vaccine. But unless that happens, there's been a lot of damage done already, and I don't see a V-shape recovery. I see more of a U-shape recovery, and what I would like to do, I know I've been extremely depressing, but the situation that we're in, I have studied financial crises for 30 years. And the situation we're in is by far the most serious that I've seen, not just in my lifetime, but prior to my lifetime. There are very few instances of something this big. So I don't have a lot of reason to be upbeat at the moment. But I'm happy to turn now to address, I'm sure there are many things and many questions on topics that I have not addressed, but I tried to give you an overview of what I see. I have, with my co-author Ken Rogoff, have been calling for a temporary debt standstill for many emerging markets. The G20 agreed, late last month for a temporary standstill, 6-month standstill, suspension of debt payments, official payments to official creditors, not to private creditors, for the 73, 76 poorest countries, which does not include the big ones in Latam. It does include Bolivia. It does include some of the smaller, it's the IDA country. So even though, for example, some of the small Caribbean islands do not have the low per capita income that you need to qualify for being an IDA country, International Development Agency. They, because of their very small size, qualify for being in that group. Also, Nicaragua and other Central American countries are also part of the IDA countries and therefore subject to debt relief. I think the situation is serious enough that I wrote about this in the Wall Street Journal with Ken Rogoff and also subsequently in Project Syndicate. And I think, making the debt a temporary debt standstill, so governments have more tools to be able to spend on medical and the necessary support during this period, support that it be made more general. Let me stop there and take questions as they come.
Thank you very much, Carmen, for this very valuable and comprehensive commentary on the state of the crisis worldwide, and particularly with a look at Latin America. We have received several questions via email and on the question and answer window, and you are welcome to submit them as you're able to, and we'll get to them, and we'll be consolidating some that we feel are similar. Carmen, we have an interest among participants in reviewing the particular impacts of the crisis in individual countries. We've received from Michael Amezaga questions about the particular effects on Guatemala, from Julio Ramirez on the Chilean and Peruvian economies. What are your thoughts on some of these individual countries' responses, their outlook, and some of the government responses as well?
So let me start with Guatemala, and this applies to Central America at large. If you look at the IMF forecasts, let's start there. In April of this year, the IMF published the World Economic Outlook. This is in connection with the IMF and World Bank meetings. And you can see the individual projections, and it is across the board a prediction of recession. So this applies to Guatemala, this applies to Chile, this applies to Peru, not in uniform degrees. I will talk more about that. A big issue for Guatemala and other Central American countries is that at the time of the IMF, annual IMF World Bank meetings, the World Bank also published its annual estimates for 2020 remittances. And Guatemala, like many other Central American countries, or many, I didn't mean to say Central American countries alone, but many other developing countries, the largest recipients of remittances are the Philippines, Pakistan, but Central America is very high on the list, Guatemala included, very high on the list. The World Bank estimates projected a decline in remittances year over year for 2020 of about 24%. For LATAM, somewhat less. For LATAM was a decline of about almost 20%. For Asia as a whole, it was the lowest level of decline. The hardest hit regions were the Middle East and Central Asia. But this goes back to the earlier comment that I had made about the reversal of capital flows. What we're dealing right now is with countries that, are going to have a very difficult time carrying out the expenditures that are necessary to cope with the COVID crisis and all the dislocations. Guatemala was recently able to issue debt in the financial markets. We've had a lot of issuance of debt, and I think it makes sense because what countries are doing is, I think they're racing against the credit ratings. They're trying to raise funding, and businesses are doing this as well. We saw that in the commercial and industrial loan data for the US. So it's precautionary, if you will. So they were able to issue and place debt last month. And, they are coping with a recession. They are coping with a decline in remittances. Now, the Mexican remittances were surprisingly strong relative to expectations. So maybe, there's no need to be overly negative over the very near term. But I think if this thing lasts, the hit is going to be very hard. So, you know, beyond saying that, you know, the IMF is providing, you know, their rapid financing instrument, which they introduced during the IMF is providing, you know, and approving each day. You can go to the IMF webpage and see the list. I don't remember exactly whether Guatemala has already received it or has asked for it and yet not received it, but if it hasn't, it will, because they're moving as quick as they can to process the request for the rapid financing facility. But as I said, it's important that they were able to issue debt and tap international capital markets. But I see that situation as just becoming much more difficult as recession, you know, sets in. On Peru and Chile were the two strongest economies in LATAM, especially Peru, actually. Chile has normally been the star performer for many decades now. They were the first to come out of the 1980s crisis. They came out with much higher growth. They've had, you know, very, very solid fiscal performance and are, you know, really highly rated relative to any other LATAM country. But both Chile and Peru depend importantly on mining, and both Chile and Peru had, I was in Peru last year, or was it I was in Peru last year, but I was there the year before last also, and it was what I did, which included Chile as well, is for the Pacific Alliance countries, I started looking at their correlation of 5-year GDP growth with this is relevant to your question of the correlation with China's growth, because both Chile and Peru had seen a surge in trade and the commodity trade and trade in general with China. So what happens is China is very important for Chile and for Peru. So what can I say? I think among the region, you know, comparables in the region, they're the two strongest economies still, notwithstanding the shocks. They had the most fiscal space to deal with the shock. They have significant credibility in the central bank, so that they've been able to lower interest rates successfully to try to help local businesses, you know, maintain access to credit. They've tried to provide liquidity also to avoid, you know, a disorderly scramble. I'll first say what worries me most about both of them, and this is, I don't see China's growth rate going back to 6%, which is, I mean, China's growth rate on average 2003, 2013 was over 10%. I've already mentioned this. Then post 2015, it ratchets down significantly to about 6%. Still pretty spectacular. I'd take that any day. But I don't see that going back to a steady state of 6%. And I think, you know, that has implications. That and the rest of the world have implications for global commodity prices, you know, for investment. Investment is closely connected with mining, more than other commodities. Mining is connected to investment plans, and investment plans, I think investment is going to be relatively depressed for some time because of overcapacity issues and, you know, the crash in world demand. So what can I say? I think in terms of being strongly poised to navigate this, I think those are the two countries in Latam that are best in, best poised to navigate this difficult situation. Let me say one concern I have about Chile. I actually have two concerns, but I think one is bigger than the other. As we all know, Chile has been seeing a lot of unrest because, issues of inequality have come to the forefront, and much of this was triggered by what was a pretty trivial increase in the price of a necessity. I mentioned earlier that I'm worried about price increases in food. Price increases in food anywhere and everywhere are regressive, meaning they hit the poor the hardest, because food, look, let me give you the macro overview, and then it fits at the personal level as well. Advanced economies like the US, wealthy economies, food is 10% or less of the consumer basket. For the very poorest countries, I'm talking about the very poorest, it's between 50 and 60%. And for the emerging markets like Chile, like Peru, like much of Latin America, somewhere in between. But what I'm getting at is, if Chile has come into this with concerns about inequality, a lot of social unrest in that dimension, I think that is an area to watch as a source of concern, because I do think that we are very, very vulnerable to a hike in food prices at the moment, and that is strongly regressive. Then there's the second issue I wanted to raise about Chile, which is, a lot of the corporate debt is external. A lot of it is in dollars. A lot of that debt is also associated with parent companies that have, global commodity companies, where it's not really external in the usual sense, but it's still, corporate external debt in Chile is the highest it's been. And it's a potential issue, especially if the dollar continues to strengthen versus the Chilean peso.
Carmen, on that note, we have a question from Hugo Wood, who's from Panama. Wants to know your thoughts on the economic prospects of dollarized nations in the region, Ecuador, El Salvador, and Panama.
Well, they're very different situation. Very different situation. Ecuador and El Salvador have serious debt problems, as in serious debt problems. As in, Ecuador at the moment is negotiating with, bondholders to try to avoid a default, just a full-fledged default. It's already missed payments. And, they're trying to avoid the default. As you know, the three economies, El Salvador, Ecuador, and Panama, do not have their own currencies. So, the whole idea that the central bank can, depreciate the currency, the central bank can, print pesos to help the liquidity situation for the local banks, that's not an option, right? These three countries have one and only one instrument, which is fiscal policy. And in the case of Ecuador, it is very compromised because their break-even point for oil, I mean, what do international oil prices need to be in order for the budget to break even? It's over 40, okay? It's over 40. It's like, I think like 45 or 46. It's over 40. So, and remember, Ecuador's oil prices are below what you see for the Brent crude. So they're actually lower than the international quotes we see. So that is a major problem. It's a major problem. And a positive scenario is one where they reach some agreement with the creditors. This goes back to what I had mentioned earlier about my recommendation with Ken Rogoff for a temporary debt moratorium, that the creditors agreed to say, okay, we're going to give you 6 months, we're going to give you 12 months so that you can deal with the health emergency, and we won't expect, we'll give you that grace period. That's not unheard of, by the way. And we are also seeing that at the local level here. I mean, many small businesses and households, banks are giving households grace periods in terms of repaying mortgages and other debt. Small businesses, also the Federal Reserve's new facilities do have grace periods for borrowers. So the idea of a grace period is not, so that's a good scenario, or not good. Okay, there are no good scenarios, but that's a better scenario for Ecuador. That would help them, at least over the short run, avoid default. El Salvador and Ecuador had running fiscal problems. Another problem that Ecuador has that El Salvador doesn't have, but Ecuador certainly has it, is one has to be very careful also that when one looks at Ecuador's debt, one is taking into account Ecuador's debts to China. After Venezuela, Ecuador is the largest borrower in this hemisphere from China. And I've done, quite a bit of work on hidden debts, because Chinese lending is very opaque. It's not published. There's a lot of secrecy. There's a lot of secrecy in terms. So Ecuador already restructured its debt with China once. But what concerns me, okay, here's what concerns me in the context of Ecuador. Venezuela was the country that had the largest amount of debt owed to China. Like Ecuador, most of that debt is collateralized by oil. So Venezuela has had the most spectacular output collapse, more than 70%. In peacetime, in World War II, you had countries that were bombarded, and you saw collapses in output of that order of magnitude. But in peacetime, you don't see that. And despite having had an economic contraction that is out of the league with everyone else, out of the league with any experience, having had every major health and social indicator plummet in the worst way, in spite of that, they have repaid China's debts. They've done that by shipping oil. I hope we do not see that anywhere else, because I think it is just, it's beyond the pale for a country that is going through such hardship that that it continues to service its debt, when the alternative is to use whatever scarce dollars it has to import necessities and the like. Panama's in a different situation. They're not as severely impacted by the commodity cycle, but they're a country that's also very connected to international trade. And so, I go back and point you in the direction of the IMF's World Economic Outlook, which, you know, basically points in the direction of recession for, you know, practically across the board. For the commodity producers, because of a crash in commodity prices, because of for the small countries or large countries that depend on tourism, because tourism has fallen off a cliff, and for countries like Panama, in which trade activity, global trade activity is important, that's also depressed. So there's not like you can say, oh, this is my magic bullet here. But you know, if you're, you know, have greater interest, there's all kinds of data on the forecasts for these three countries and for every country from the IMF in the World Economic Outlook, and those forecasts, you know, go out into the early 2020s. Although they, by the way, they've been revised down in the last month, so, you know, bear that in mind.
Carmen, you have shared many reflections on the impact of the crisis and the relationship between the region, Asia, particularly China. I wonder if you could share your thoughts on the impact on business between the region and the US, and the outlook for the financial relationship between the US and Latin America moving forward.
So, I don't know that at the moment I would be expecting, you know, major changes on that relationship, because I think again, we don't know what the outcome of the US election will be, but whether it is Trump or whether it's Biden, I think the focus of international relations going forward is going to remain with China. You know, as you know, we've already gone through the revisitation of NAFTA, which involved revisiting the relationship of the US with, obviously, with both Mexico and Canada. But I think that was sort of the biggest, you know, revision, if you will, of, you know, US external relations with the region. I think the focus of whether it's the Trump administration or whether, you know, it's Biden, will continue to be with China. I think that, you know, the IMF and World Bank, of which, you know, the US has the largest vote. I think the IMF and the World Bank have been both very well disposed thus far to, you know, support LATAM and various countries in LATAM as much as possible in providing, you know, through their new facilities, providing resources to fight COVID. So via the multilaterals, that includes, you know, the Inter-American Development Bank, obviously, you know, I think the multilaterals will be, you know, a channel. But again, I'm not really looking for any in-depth substantive change, you know, like what we had, as I said, earlier in the Trump administration when he, was going on about the wall and the revisiting of NAFTA and all of that. I think, I don't think LATAM is going to be in the spotlight.
Carmen, and looking ahead at the road to recovery, what are your recommendations for individual countries, for the governments, but also for the private sector in the respective countries in the region, but internationally as well? How can governments particularly unlock the potential of the private sector to catalyze recovery? And what would be the role, potential role of US business in that road to recovery?
So look, it's, the range of variation in countries in the region, as you know, is enormous. And we've been talking about, how big that is. So as a minimum, I think the best policy response is one where, there is a concerted effort towards a unified vision, if you will, a unified vision of how to deal with the pandemic, while at the same time not paralyzing economic activity in its fullest form. And I say unified vision because one of the things that's been costing Brazil a lot of credibility is the fact that there hasn't been a unified country vision of how to deal with COVID. Ditto for Mexico. So you've had two candidates, AMLO and Bolsonaro, at the opposite ends of the political spectrum, and both of them have not conveyed to the rest of the world, a vision of what the nation is doing as a nation to deal with the disease. I think formulating that and articulating that to the rest of the world, and more importantly, implementing it, is critical. I think realistically, LATAM should also look at the Swedish model, which has Sweden, as you know, and it's still controversial. We don't know, but it's tried to balance out more the distancing policies with minimizing economic disruption. And if you look at Swedish GDP, of course, everybody's in recession. Everybody's, but it's the damage done to the Swedish economy was more modest. I think the reason I bring that up in the context of LATAM, and not just LATAM, but many other emerging markets, is, look, these countries don't have the resources to say, I'm going to do 10% of GDP fiscal stimulus because I know the rest of the world is going to buy my debt, which is this US situation. They're not in a position to do that. So I would start out with articulating a nationwide, which countries like Colombia have done, for example, very, very successfully. Trying to do the balancing act between, opening up a little more and seeing, cautiously how it goes. I say the Swedish model is out there. I think doing whatever it can to avoid, in the most extreme cases, falling into default, because if the sovereign gets hit, that reflects entirely across the spectrum on the private sector. You know, this is the sovereign ceiling problem. So I think, you know, countries have to be very, you know, very cautious in taking on new market debt. I think they're better off relying on the multilaterals, on the World Bank, the IMF, the IDB, to the extent possible, because, you know, again, risking taking on more debt at a time like this, unless you have the fiscal space, you know, which I mentioned Peru did, Chile did, both have tapped capital markets. You know, I think that's also a factor. I think one, so those are some of the do's. Some of the don'ts involve the return to protectionism. Since COVID began, and I mentioned the issue of my concerns about a food crisis and a relative rise in, you know, a rise in relative food prices as a source of concern. In Asia, more than in Latam, but in Asia, what we've seen in Vietnam, we saw in Cambodia, we've seen it, you know, in the Philippines, we've seen a bit of food protectionism, that is, you know, hoarding, and things that really start, you know, once these inward-looking protectionist policies gain ground, they may prove difficult to reverse, and I think that is very would have you know, very adverse consequences for foreign investors. So maintaining transparency, maintaining a market-friendly, more open attitude, which is easier said than done in this environment, I think is important, on not exacerbating, you know, the effects of this horrific shock. I will say this, and even if countries do that, even if they avoid the don'ts and do the do's, I would not look for a lot of foreign direct investment very aggressively over the very near term. I do think it's an opportunity for LATAM to see some of the trade, you know, the supply chains directed more to the region. It's a great opportunity. I mean, I think part, you know, given the tension between the US and China, which have not gone away and will not go away, as I said, irrespective of what administration is in the White House, I think this should be seen as an opportunity for the region to try to fill in the gap as supply chains can be reoriented more to the regions. But again, I do not see the kind of vibrant, you know, a vibrant environment for foreign direct investment or for portfolio investment, for that matter.
Thank you, Carmen. And we're nearing the end of our conversation, but I wonder if you could briefly address the situation, your recommendations and projections for tourism-dependent economies in the region, particularly the Caribbean. Of course, Cuba will be particularly affected through its tourism sector, and places like South Florida.
But Maria Carla, I can't really do that. I really can't. I mean, tourism is the one thing that is like directly dependent on how well or how poorly we fare in controlling the disease. I think a lot of the isolation or, you know, confinement or whatever you want to call it, distancing that we are seeing is also voluntary. You know, it's also individuals are afraid to travel. And I don't have, you know, I mean, how likely is anyone in the state where I normally live in Massachusetts right now or in the near term to get on a plane and go to Barbados or go anywhere? You know, I think the answer to that one is really strictly in the hands of the, you know, the medical profession and or the disease, whether we find a vaccine, whether we find better treatment, whether there's evidence of a second wave or not. I think those are critical for tourism, critical. Beyond that, what do you say? Well, you try to, you know, get as much support from other areas. In the context of Florida, I think, you know, the whole idea that one can simply redirect from a service tourism focus to something else over the short run is just, it's not realistic. I think one tries to get also support from the government. In the case of the smaller islands, I mentioned already that many of those islands are part or entitled to the temporary debt suspension. Others that are not, in my view, should be, so amplifying the debt moratorium so they have more resources to deal with the immediate crisis. But the idea that you're a tourist-based economy and you can become something else in short order is just, it's not realistic. It's the same, I've been hearing the same story about commodity producers for 30 years, you know, oh, we export oil or we export, you know, and yes, there are plenty of cases where there has been a lot of diversification. That was true, you know, some diversification, even though Chile remains extremely dependent on copper, you know, some diversification in Chile. There's been diversification, you know, once Malaysia was a rubber plantation, you know, but you don't do that in short order. It's, you know, it's, so it's not, I'm sorry for the lack of affirmative, but it really is. Tourism is the one area, and anything that involves travel is the one area where I am afraid it is sort of the last leg of the list, you know, that you can talk about normalizing, you know, access to restaurants or to stores or to, you know, other businesses. But I think travel, especially international travel, is not going to be high on that list. I know Harvard was the first thing they did, the very first thing, before closures, before anything, the first thing they did was suspend the international travel of official international travel of any faculty or employee. I was supposed to have been in London giving a talk at the London School of Economics on March 12th, and that got canceled pretty early on, even before President Trump introduced travel restrictions. So, you know, it's not, I think that's, anyway, that's not an upbeat comment, but it's, I think, pretty realistic.
Thank you very much, Carmen. We really appreciate it. I'm sure I speak on behalf of all participants. It has been really an honor to hear from you and receive this very frank, comprehensive assessment of the crisis on a global scale, but with this particularly helpful assessment of the impact on the region. I don't know if you would like to share any final thoughts before we formally conclude. We'd just like to remind the participants that we will have this recording available to everyone. This and other resources and previous events that CasaCuba has hosted are located on our website, casacuba.fiu.edu, where you can also subscribe to receive updates on our activities and upcoming webinars, a lot of which will be related to the impact of the crisis in Cuba and the region. I also want to thank the CasaCuba team, Maite Morales in particular, for the help coordinating this event. I really want to reiterate to you, Carmen, how proud we feel of having you, an FIU alumna, Cuban economist, taking the lead in the country and the world at large, being a voice of analysis and projections for the road to recovery. Would you like to say a few words to conclude?
I would like to thank you, and in perhaps different circumstances, I hope to have the pleasure of doing this in person.
It will be our pleasure to welcome you as soon as travel and tourism resume. Thank you so much, Carmen, and thank you everyone who has joined today. On behalf of the CasaCuba team and FIU, we wish everyone health, safety, and really hope to see you in person very soon.
Bye-bye.
Bye, everyone.